Hello investors, thank you for joining me. My name is Michael from Deep Value Returns and Seeking Alpha. Today I want to talk about Amazon. So Amazon put out its Q4 guidance and it's not looking particularly promising. So I'm going to talk about how investors should think about Amazon looking ahead, particularly as we start thinking about next year. We're going to talk about Amazon, whether it's a COVID trade or not, and then we're going to talk about its prospects. Finally, we're going to bring this all together and talk about its valuation. So one of the things I wanted to highlight, so in this graph here, I've highlighted 4 companies that are totally unrelated to Amazon, but these are companies that many investors have seen as being COVID trades, okay? So I've highlighted Pinterest, Zoom, Peloton, Teladoc. All these companies are down significantly in 2021. So if you think about, these are the winners from last year, and the market is saying, okay, those had a one-off bump, and we are unloading those positions because we have question marks about the sustainability of their growth rates. Okay, so this is the key takeaway. We're going to talk about sustainability and whether or not Amazon has enough sustainability and whether investors are perhaps too gloomy over its prospects. Okay, so here's the thing. Q3 just reported, and Q3 was plus 15% year over year, okay? So if we look back, it's been a while since Amazon's reported Q3, Amazon reported just 15% of year over year growth rates. Going into Q4 at the top end, it's looking at 12%. So if you think about it, it's a tough comp, right? If you look back to the whole 2020, they were growing close to mid-30s to 40% compounded annual growth rates. Particularly Q4 was up 44% year over year last year. So against that really heavy comp, it's always going to be difficult. And they say quite openly. So they're saying we are looking out to Q2 22 for them to start once again putting out strong growth rates close to that 20% that we as investors have been historically accustomed to. So what they're saying right now, there's this dip as it comes up against the heavy comp, but as you look at the stacked, if you look to Q3 19 to Q3 21, there's over a 2-year stack, they've been growing at approximately 25% compounded annual growth rate compared to the low 20s that we were seeing historically. So yes, they did get a bump and they did get some pull forward in revenues, and as we comp that, it's kind of looks not so great, but this is temporary, right? The other thing that I wanted to highlight is that there's a lot of supply chain issues, but these are temporary aspects. So one of the things I wanted to put out, so I asked the question, is Amazon still a growth company? Okay, so 15% of what Amazon is AWS. Okay, just 15%, but that makes up 100% of its operating profits. So it's a whole same story that we've seen for years. AWS is growing, it's highly profitable, and they're able to use that strong operating margin to reinvest back into the retail business. The quote that I put here, that I took from the press statement, is that we're going to do what's best for the customer over the long term. So nothing has changed significantly. And you can see here, these are just the figures here, so you can see that on the retail side for North America, they went from 2.3 billion of operating profits last year to just less than a billion of operating profits this year. So it's gone in the wrong direction, the operating profits, and what they're saying is essentially, okay, yes, we do have a lot of these increasing wage costs, supply chain issues, freighting, shipping, supply shortages, but a lot of this thing is temporary and is supposed to kind of even out over the next several quarters. One more thing that I wanted to highlight is that yes, they did pull forward a lot of their growth prospects before the pandemic relative to now during the pandemic, but they're able to continue to increase their fulfillment capacity. So looking back since the start of the pandemic, they've been able to nearly double their fulfillment capacity to meet demand. So even though they continue to invest in increasing their capacity, the demand is very, very high for them. And this, in the retail side, you're getting medium-sized purchases very, very frequent. So it's a very, very sticky customer. And if I say to you sticky customer, typically you think about a SaaS company and you'd look at a SaaS multiple, above 10 times forward sales at least. In the case of Amazon, you're really not paying that. So you can see here in Amazon's case, you're paying 3.6 times forward sales. So if you think about it, this is towards the lowest end it's been for this year. And investors are quite despondent here. Investors are kind of like, okay, I don't want to really be touching this because we're going to have to wait at least 3 quarters or so before they're kind of back on their growth trajectory. But what happens is that if you pay a low multiple right now, as they get into over the next 3 quarters or so, and we start to see that guidance improving, by that time the market will already expanded its multiple closer to 4 times forward sales, and you'll already be getting some of those gains up front. So investing when other people don't want to invest is often a good strategy. One more thing that I want to highlight. So if you compare, I'll just put out some numbers here. So compared against Apple, Apple's price is 6.5 times next year's revenues, and against the other big cloud player, which is Microsoft. Microsoft is priced at 12.7, let's say 13 times forward sales. In that context, 3.6 for Amazon is very, very cheap. I mean, it's a company that has a long history of being innovative. So if you think about Amazon, so where AWS came from was essentially an operating cost the business had. They were thinking, okay, we have to have this operating cost. Why don't we just sell it to everyone else? So Amazon has this ability to turn what is a cost for them into a revenue stream. The other thing that I want to highlight is Amazon's advertising business. So this is again, something that they kind of came up with and is growing very fast. So for the last quarter, within included Amazon Other segment, it was up 49% year over year. So within Amazon Other, it's not only advertising, but it's mostly driven by advertising. And this made 5.4 billion in revenues. Okay, so just give you a bit of context to think about that. Okay, so if you think about the Trade Desk for Q3 is expected to make 300 million in revenues. Okay, everyone is going bananas for the Trade Desk, and there's good reasons. I like the Trade Desk, but they're making 300 million in revenues for this Q3. Amazon has just made 5.4 billion. The thing I may kind of ingest here is that what Amazon makes as a trading as an accounting error on a decimal point is what the Trade Desk makes in revenues. So if you think about it, advertising is just so profitable, and it just gives them so much more flexibility to continue to invest for growth. So all in all, I make the case that it's, right now investors are kind of despondent because there's all this overarching inflation issues, supply disruptions, but Amazon is a lot more sustainable and resilient and highly innovative than many give it credit for. So with that aside, I know that the outlook is slightly grey right now, but I think that this is an interesting time to get involved with the stock. I'm a small cap stock picker, so I typically go towards smaller cap names, but if you want to find out what kind of names I'm particularly excited about right now, don't forget to check out our marketplace. It's called Deep Value Returns. I help you become a better investor. I help you think through your portfolio. Okay. With that aside, hope to see you guys next time.